Okay, so let's start on, or touch on, sorry, capital gains tax changes. Because, as you talked about, those are going to effectively be a minimum capital gains tax rate of 30% and a shift from a long term capital gains tax discount regime, where if you hold it for more than a year, you've got a 50% discount, to indexing the initial capital base. So I have some thoughts about this, but what do you think this is going to do to investors? And do you have any predictions about how investors might change their behavior around these tax changes?
Yeah, you should tell me your thoughts as well. But so I think if you do the modeling, we'll see that there are actually certain circumstances when investors are actually better off under the inflation indexing scheme under very specific circumstances. Those are when you have higher inflation, when you're in a high inflation regime, and under shorter holding periods. Say, for example, you have 3% inflation and just 4% capital growth, then you're actually better off in the first 10 to 15 years under inflation indexing. Meanwhile, most of the times, if you have longer holding periods, say 15, 20 years, or if you're in a stable inflation environment, or if you have much higher capital growth than inflation, then you're worse off under this new scheme. So what this means is that, for example, with shares, investors are going to prefer dividends shares rather than companies banking that additional windfalls and paying investors through capital growth, right? Because you're punished by holding it for longer. Which again, this is an interesting implications because actually Australian shares are actually the most among the most highly paid dividends in the world already. That people buy Australian shares for dividends. Meanwhile, we actually want to promote business investment within company over the longer run. So I think that incentives is now gone. So that would change how companies decide to use their additional cash, additional equity in terms of dividends or banking them. Similar to other asset classes, I think that because you're better off in shorter term holding periods, so you actually might see a little bit more shorter term turnover than otherwise. It actually discourages you holding the investments for longer. I mean, investors are smart. They're not dumb people, so they would try to make use of the tax as as best as they could. So I think that's what they would shift to. Yes, they would shift to new housing rather than existing. They might try to keep their investments towards venture capitals because there are some tax incentives for that, but they won't be holding that investments for much longer. I also think that it's quite interesting to see some tax incentives in terms of small business and venture capitals as well. It's not a bad thing to give that tax incentives because again, like I think Australia just needs more business investments overall. Again, it's been so stagnant since 2015 onwards. But it also is a little bit of a tall poppy syndrome in Australia because why you punish when you get a little bit bigger? Obviously it is a small country here. We have a lot of duopolies and monopolies just because of our size. It is a small size. So in order to have efficient economies of scale, you have to grow big. You want companies, you want businesses to grow into bigger sizes. But a lot of the tax incentives are geared towards only for to keep your business at a certain size, which I thought is quite a bit annoying actually.